Sorry, audio. My bad. Hey everyone again. Thanks for a lot for tuning in. So I the we started doing these sessions this month, trying to do one a week. We'll see if we can hold on to that. Just to kind of walk you a little bit through some of the stuff that we've learned running a startup and helping a bunch of companies with their fundraising. And this is the session. This is probably the most. I think it's the most important session because the most crucial thing that you have to do as a founder is not running out of money. And a lot of companies just don't know how to do that. Uh, and again, but it's also a very intensive, very nerdy spreadsheet session. So we're going to try to make it. I'm going to try to change it up a little bit, make it a little bit fun, and so that you guys don't suffer too much through it. But overall, I think that the biggest thing that we're going to do today is we're actually going to model a business. We're going to model a SaaS company, and we're going to build it from scratch. And some of you guys will be listed as co-founders, and we're going to budget how much money this company needs to thrive. So let's just jump right in because there's a lot to cover today. We have a couple slots for questions. We have some of you guys are on our YouTube live stream. Hello. Some of you guys are on our Zoom link. Also, hello. I have both of your windows here in my dashboard, so I should be able to get to your questions, and I should be able to multitask. And we'll make a couple pauses to make sure that I'm not leaving anybody behind. So, why do we do this? I mean, why do we understand this? Because we've been helping founders prepare for their fundraising. Over 2 million companies have gone through our Slidebean platform. And there are these problems that we keep seeing again and again with pitch decks, right? When a company pitches, shows us how they're preparing to pitch investors. The first thing that's a telltale sign that they're not doing their homework on this chapter on the financial side is that they just come up with these random numbers for how much money they need to raise, right? So a very arbitrary round size. Oh, we're raising a very nice round $1 million, or maybe we're raising between $3 and $5 million. And so, what? That's a huge range. You need 3 or 5. That's kind of like a very big range. Another telltale sign that somebody doesn't understand their financials is you just see these hockey stick charts coming up everywhere, where they just assume that they're just going to grow 10% every month magically. And then the other big flaw is you see founders that, they pitch the whole company around, hey, we're going to raise 18 months of runway. But what happens after 18 months? Like, are you going to be in a good position to raise money again after 18 months? And most of the time, that isn't the case. We made that mistake ourselves, and it almost killed our company. So how do you solve this? What's the solution to all these problems? You might have run into these terms, a pro forma template. Maybe somebody asked for that. Maybe you Googled a runway calculator. Maybe and you're just wondering how much you need to raise. But overall, the answer to this question is a financial model. That's what a financial model does. It helps you sort and solve through these things. But I actually hate the word financial model. It's a bit of a mouthful. And today I want to do my best. I'll do my best to demystify it as much as I can. So let me walk you really quickly through the very first financial model, the very first spreadsheet that we're going to look into today. So whenever you look at a financial model, you're probably going to, probably the other ones you look at are not going to be as pretty as this one, because this one has really nice color coding. We've done our effort. But overall, you're going to come up with something very similar to this, where you have revenue, where you have your costs and your expenses. If you've looked at your company's P&L, or you've looked at a P&L in your life, it looks exactly like this, right? We have revenue, first income, and then your costs, and then your expenses. So what's the difference between those? The first thing you'll see is, for example, if I set this to say $1,000 in revenue, and I spend $500 to generate those $1,000 in revenue, I'm going to have my first metric here, which is my gross profit. Gross profit is how much this business at its core costs, right? If you run an Uber, for example, if you are Uber and you bill $1,000 worth of rides, but you have to pay $800 worth of rides to your drivers, and then you have to pay, I don't know, probably like $5 or $50 in this case in server cost and infrastructure, and you're left with something like $150 in gross profit. That's kind of where gross profit comes from, right? In the sense that we're not looking into staff, we're not looking into the team, we're not looking into marketing even. We're just looking at the core of the business. And the thing with this is that as revenue scales, these costs probably scale proportional, right? So if you have twice the revenue, it'll cost twice to generate it. If you're in e-commerce, you sell $1,000 worth of t-shirts, you spend $800, maybe probably not, maybe $500 to print those t-shirts, and then $200 in shipping. And again, this proportion of gross profit is probably going to exist for the rest of your company's life. And that number should never, ever, ever be negative, because otherwise you're not building a business, you're just building a money dump. But of course, we haven't looked into the team, right? So where does that fit? So the team normally would fit kind of like here, right? So this is the expenses section. Again, in a P&L, or if we don't have the color codes when you're looking at this, it's probably going to look, let me hide this so we have more space. It's probably going to look like revenue, costs, and expenses. That's normally the way people call it. And yeah, you can set it, some team members. So I'm going to set myself as founder, give myself some salary. I set myself a start date, and yeah, I'm just going to add Lulst. I don't know, Lulst from our YouTube live stream. It's going to be my co-founder. Lulst. I'm mistyping this, but okay. Yeah, and we're both going to start around the same time. And if you do this, notice that we may have this revenue every month. Let's copy this. We may have these expenses every month, right? But aside from that, we're operating at a loss because we're paying ourselves, right? But again, this is not necessarily a bad business, because at its core, the business makes revenue, and that revenue is higher than our costs, right? So there's profit. But then if you look at the team, that's when you go negative, and that's fine. But what we're looking for eventually is to scale revenue, which is going to scale costs pretty much proportionally, make this number a lot bigger so that it covers our operational expenses. That's just the very, very basic of it. But how do we estimate revenue, right? How do we know how much revenue this company might make? How do we calculate that? So I added some functionality into this little sheet. I'm going to give you a copy of this soon. Don't worry. But yeah, I added the simplest SaaS business model. And what it basically lets you do is say, okay, like let's say that we start working on this company together in March, and that means that by May we might launch this product, right? We're going to get 50 customers in May. And then next month, I'm going to take those 50 customers and I'm going to multiply that by 110%. Right? We're going to grow our customer base. So we're going to get 50 customers in May, and then 10% more. So 55 customers in June. And I'm just going to drag that formula. I'm just going to extend this all the way up to the very end of the model, right? So we'll see how that number scales. We have some churn rate too, right? So some customers will cancel. Fine, maybe 5% of them will cancel. And then we have our revenue, right? So, how much do we charge for this product? Let's say that we're building a SaaS and it's, I don't know, $79 a month. And by doing that, by just inputting these values, notice that the inputs here are blue. It's going to be important later. We have revenue, and we have revenue that scales, and see that, this first month, it doesn't really cover our salaries, but then next month, we only burn $200. The next month, we're in profit. We're making 4,000 and then 8,000 and 13,000. That keeps growing. And if we zoom out to our annual version of this, right? Zoom out to see how that extends to years. By year 7, this little company that we came up with is now making, what's that, $400 million a year. Now there's something critically wrong about what I just did in this spreadsheet. I did it quickly, so yeah, that's a little bit of a trick question, but let's see if any of you guys caught it. What did I do wrong? I added my expenses, I added my revenue, I added my customer forecasts, but what's wrong with the way I forecasted revenue here? What do you guys think? I'll give you guys a sec, see if you guys can get it, and then maybe I'll give you $1 if you get it right. I see Steve Miller. Not comparing oranges to oranges. No, not really. Growth assumptions. Jennifer, I think you're on the right track, Jennifer. Yeah. Static assumption. Yeah, along those lines. This actually is not too different from a story that I got from a real founder. This is a real founder quote. Hey, we're going to generate 700 orders the month that we launch this product. And then this number is going to grow 10% every month, right? And if you do that on a spreadsheet, You take 700, multiply by 100%, 10%, which is what I did. Drag that formula along, and then draw that into a chart. It looks like this, and it's very pretty. It's pretty. You can put it on your pitch deck, and it shows like a really exciting company. But this is just it's trash. You should never, please don't do this. Some of you guys might. I've seen like seasoned founders put this on a pitch deck. I've seen like large companies that operate with revenue and a team, and I've seen CFOs that claim to put this, to be CFOs and put this on a chart. So what's wrong with it? What's the problem? Well, the problem is that growth for a company doesn't happen magically, right? It doesn't happen um, because you put it 110%, right? What says is 10%, not 9% or 3%? Like, what are you, this model, this spreadsheet isn't assuming that we, the company, are going to do anything to create that 110%. Like, how much money do we need to grow 10? I mean, to grow 10% from $1,000, or I mean, from 50 customers a month to 55, well, maybe you sent a couple extra emails. But when you're looking at big numbers, how do you go from 50,000 customers a month to 55,000 customers a month? That's a huge, that could be, how do you understand how much money you need and how much effort you need to accomplish that? That is the key. That is the key and if there's any lesson that you guys want to take from today is, yes, please don't do 10% and drag formulas. But more importantly, like, just understand, we have to understand like what's driving these things, right? Somebody mentioned in Zoom, like Luis and Ryan both mentioned static assumptions, right? Because we're saying, well, our revenue wasn't static in the way we forecasted it, right? We were saying 10% growth and we dragged it. But if you look at expenses, right, our team, well, it's just two founders, and that's just two founders forever, right? So there's something's like, we can see that something's wrong, right? This company assumed that two founders were going to make $400 million a year, and that's it, and there were no other expenses for this business. So some of these things have to scale, right? They're kind of tied together, is kind of what we're figuring out. Something creates revenue, and that revenue transfers into more expenses, right? So we have to understand this causality here. So what could be causes of revenue? What's a driver of orders? Or orders might be subscriptions or traffic or monthly active users, whatever orders means for you. And at the same time, if we have more orders, right, depending on what we're building, we're probably going to have more expenses, right? We might have more fulfillment costs, or more hosting costs, or more support costs. Maybe our team needs to grow, right? So like there's some interconnection here, and that's kind of the key to this whole thing. We have to figure out the drivers. We have to figure out how to connect one to the other. Now, going back to where I started, with the Uber case, right? We kind of established that if you're Uber, the more revenue you make, the more you have to pay to these drivers, right? Because you have all these drivers in these mixed conditions of contractor slash employee that drive all day. And you have revenue that we understand that revenue drives costs, right? There is this interconnection between revenue and costs. But on the other end, we have what drives the revenue, right? So what causes us, what does Uber do to generate more revenue? Or what does that e-commerce company that sells t-shirts, what do they do to generate more revenue every month, right? Some examples. Well, one example could be ads, right? We've that's probably the most obvious one, paid marketing. And paid marketing, when you forecast that, you don't necessarily need to be that specific about, how many dollars you're going to put in Google AdSense versus Meta versus TikTok, right? Paid marketing could be just a bucket of budget. But we need to understand that we first have to spend that money and then generate the revenue, right? I've also seen companies that say, oh, we're going to grow 10% month over month, drag the formula, and then they'll say, okay, and then we'll take 2% of that for marketing. It's like, no, that's not the way it works. You first have to spend the marketing money. You first have to spend the marketing money and have to find a way to get that marketing money from somewhere, your investors or your pocket. And then maybe that marketing money creates more revenue. And then you can scale it, but it's not the other way around. Another potential driver could be outbound sales, right? So we have a sales team that scales. The more people that you hire maybe to do outbound sales, sorry, cold calling, the bigger your team, in theory, the bigger your revenue, in theory, right? Another potential driver could be traffic, right? So we have people going to your website, that's SEO, I guess, how do you call it now? Chatbot optimization or LLM optimization. Yeah, anyway, SEO, just organic traffic, social media, PR, stuff that drives people to your website. Um, Organically, right? Maybe you don't have to pay for these visits directly, but you have a team that kind of drives them. And then you have returning customers, right? For example, because it's a subscription, there's some churn, there's some retention, but there's maybe a team that makes sure that that retention exists, right? How do we connect all of these together, right? It's a lot of connections, but at the very, very, very basic, we first have to understand which of these are expenses, right? So let's start there. And remember our color coding, right? We have revenue and costs in red, and then expenses in this green. Sorry, in this blue. Sorry, I shut my phone. Okay, so the idea is that paid marketing and outbound sales, well, they're very much expenses to us, right? We have to, those are dollars that we have to pay to Google or to the Zuck, or those are dollars that we have to pay in salaries to people to put those butts in seats and have them make calls, right? So we have to spend that money first. And they fall into this third category of our financial model. But others not, like organic traffic, right? SEO traffic doesn't cost anything every month, right? If you have some good SEO, Google will drive traffic to you for free. I mean, it's not free, right? We have to remember that there's also a team behind this, right? It's not magical, right? There's a marketing team, or there's a retention team for retention. But the general idea is we have to first understand the expense that drives the thing, and then think of the actual driver, right? And then what we're saying is, well, this is a driver of revenue, right? And this causality that we're thinking about is that, well, these things drive revenue. The more traffic we have, the more revenue we have. The more money we spend in paid marketing, in theory, the more revenue we have, right? So how do we connect these to one another? And examples of these connections, you could connect your paid marketing budget on a cost of acquisition, right? So you spend $100 to acquire customers. A customer costs $1. You get 100 customers. Next month, you double that. In theory, twice the budget, twice the customers, right? $200, 200 customers. And that scales alongside, but you're thinking the number that you're controlling, if you will, is the dollars that you spend, and of course the conversion rate. But the number of signups, for example, is not what you input, right? You're not putting in the 10%. You're putting in the dollars that you have to spend to get to the 10% or whatever your target is. Same with outbound sales, right? We could convert that on a sales per agent. Organic traffic, we could convert that on a conversion rate, or returning customers. We can deal with churn rates to kind of convert one to the other. So this is the core of everything that we're going to do in the few minutes that we have left. And I just have to make really, really sure that you guys understand it. So this is a good time to pause for questions. So any questions so far? Zoom makes me like this little tiny window on the top of the screen. I don't love it. So I'm gonna stop the screen share for a bit so we can get to questions, and then we'll get back. Classic question: is this recorded? Yes, it's gonna be live. It's live in our Startup Club channel, so you can always check it there when you need to. Ruki is asking, does the model look different for pay-as-you-go payment models? Subscriptions for us are optional, but B2B customers who want dashboard view, yeah, I mean, yes, obviously the model looks different if you have people that will pay you 100% guaranteed every month in a subscription, versus if you depend on their transactions. In that case, what you really need to understand is, well, what's the connection there, right? Like how many transactions does a customer on average will generate on the platform, right? And you have to estimate that number. At first, you have to guess it or use some reference from other companies. And a lot of these references you can find online. When people ask me like, well, what's a good sign up? What's a good conversion rate? And I have no shame in saying, well, our conversion rate in the US for our platform for Slidebean is probably around 3 or 4%. And we know the number, we've seen it for many years, but it's not a state secret. If you Google what a freemium product conversion rate is, it's like 3 to 5%, right? At least in developed countries, and the rest of the world, it's actually lower than that. But what I'm saying is that I know what that number is. you can use a reference, but if I see a model and somebody's assuming that they're going to convert 20% of their customers, then that's kind of shady, right? That's a little sus because who gets 20%, right? It's so far away from the standard, right? So those standards can be of real help through all of this. All right, I don't see any more questions. So maybe we'll carry on. Don't be shy. That's why I'm here. I get this question, is this actually live? Are you live? Yeah. Some people ask is like they think there's some pre-recording and that we're cheating to get people to watch a very, very long video. Okay. So now we're going to jump into a spreadsheet. Or we're about to jump into a spreadsheet. I always get this link asked, so I'm just gonna give it to you right away. This is the spreadsheet that we're going to be using. I call it the good spreadsheet. You can go to financialmodel.slidebean.com/go or just snatch the QR code. My team's going to paste the links on the chats so you guys can get it. But yeah, that's the spreadsheet that we're going to be using. And like I said, like the previous one, it's color coded. So we've established that revenue is green, costs are red, expenses or SG&A, sales general admin expenses, that's blue, and capital expenditures, which we're not going to talk about too much, are yellow. And remember that we talked a little bit about that causality, right? So we're going to look into two different business models in the spreadsheet that we're looking at. And the first one is e-commerce, right? So, if you're building an e-commerce platform, and this is kind of like the advanced, not even advanced, like the complete version of what I've been talking about, right? We establish that cause and effect, and we normally work into these little diagrams, and we call them financial model maps. Where in this e-commerce example, right, we're having two drivers here we have paid marketing as a first driver, and we have organic traffic as a driver. And notice that blue arrow. The blue arrow is what we're inputting, right? So that's what we control. We control how many paid dollars are we putting into ads, and we sort of estimate how much traffic we're going to get from our website. Again, traffic is not a magic number. We have to drive it with something, but we can get an estimate on it, and we convert those two into orders, right? So how many of our paid visits make an order? What's the conversion rate there? And how many of organic visits make an order? Probably those are going to be a little different, right? So usually with paid, it's a smaller number. That translates into orders. And for every order, we're going to have revenue per order, which gives us order revenue. And then the cost of goods, right? The cost of the stuff that we shipped. And same with the other one, right? Same with for every order here, we're also going to have shipping and handling costs, right? So we have two expenses for every order we get. We have to pay for the products that we ship. We probably paid for those in advance, but we still have to account for them. And we have to pay for the shipping. In a SaaS, that's the other example I have. Software as a service. Let's think this is more like a classic SaaS where you sign up on your own. I think Netflix is a great example. ClickUp, right? Or Google Drive, the paid version, right? There's a marketing effort that they make. There's an organic amount of people that just go and visit this thing because they heard about it or they know about it. And we convert those into free trials or signups, right? These are people who are using the product, testing it out, tire kickers sometimes. But then there's that conversion rate I was talking about that gives us from free trials to customers. And then for every customer, we assume that we're going to make a certain amount of money. And of course, for every customer, we have a hosting cost. That's the way you do a basic SaaS. So without further ado, let's actually build one. Let's forecast for our business. Again, I'm going to be using what I call the good spreadsheet. My team, guys, Josh and Julie, if you don't mind pasting the link in there, so everybody can grab the spreadsheet. Okay, let me switch screens once again and go to the good spreadsheet, the good financial model. Again, this is by the way, this is a free download, so don't be scared. Just you can just grab it from the link. Okay, this is our good spreadsheet. Sorry, let me hide this because this made a mess in my screen. Okay, yeah, there's a good knowledge base here, by the way, so you can always revisit this. But I'm going to go to the FS month sheet. This is the monthly statement sheet, which is actually very similar to the one we saw earlier, right? If you recall, we had revenue and we had costs and we had expenses, just like before. Now, One big difference here is that notice that all these numbers here in revenue are are blue, or I'm sorry, are black or kind of gray. So the numbers themselves are black. What that means in well, we didn't make this up, but what this means usually in a spreadsheet, in a pro spreadsheet, is that those numbers are not inputs. Normally the inputs will be blue. So if you go, for example, to the settings sheet here, I can change our company name. I'm just going to call it Slidebean. Yeah, so notice that these are blue and there's this big highlight. It's like, hey, like we want you to change this number. Please do. When do you start the model? 2026, or you can kind of backtrack it if you want. How much capital do you have before? Like these, we want you to input these numbers. But here in the monthly sheet, you don't have any inputs, right? You don't have any way to move these numbers. So that means that they're coming from somewhere else, where they're being calculated somewhere else. So most of the work that you're going to be doing is going to be in assumptions. By the way, here's the link if you need it. Got it. Sorry. There you go. Link to the spreadsheet. And same for you guys. I'm going to do it on the Zoom thing. I'm sorry, on the Google, on the YouTube thing. Okay. So most of that is going to operate out of assumptions. So notice that assumptions does have a bunch of blue inputs. And now we have these what we call them sample revenue lines, which means that the model has that SaaS and that e-commerce that we talked about. For now, I'm going to disable them so that we are not distracted by this, because think of this thing as like, how do we tell a story about a company, right? And that story, where does it start? It kind of starts with the founders, right? It starts with the team. So let's work on that. Let's start with the team. So I see Matt asking on practice about this. Yeah, like this spreadsheet is probably going to be, I'm sorry, this spreadsheet is going to be your practice. So let's have Matt be the CEO. I'm gonna be around. I'm gonna be the COO, and we're gonna have Stefan be the CTO. By the way, this works, Stefan. This works online. This works in our platform because we keep the model updated with stuff and so on. So no, you can't download it, but you can always use it on our platform, and it's free. So this is a team of 3 founders. Let's enable these roles, right? And what we have here is the salary, right? So when do we, when are we going to pay ourselves? I'm just going to go with 60, depending on where you are in the world. That sounds like a shit ton of money or nothing, but I guess we'll just use that as a standard. And then we have the start date, right? So when do we start working on this? When do we start working on this business? Let's go back to the monthly sheet. Now, the first thing that we have to understand is that raising money is hard. Raising money, and it takes time, right? I've seen founders kind of say, "Oh, we got together today. We're starting work on this spreadsheet today, and we're gonna start paying ourselves next month." It's like, really? Raising money, like it took me about 6 months, probably like 8 months, and the standard is about 6 months. So in reality, if we are here in February, if we get together, start working on this March, right? Chances are we're probably going to be closing somewhere around September, I'd say. And if you want an extra tip, like September is really a bad month to close money because all freaking investors, they're all out on vacation in August. So you can't really, not a lot of transactions happen in September. You're probably looking somewhere closer to October, right? So like we have to assume that through all of this time, we're not going to have any money. And we're going to have what we call pre-seed close. And we can use this milestones line here, notice that it's blue as well, to kind of put these milestones across the sheet. And if we go, for example, to revenue, we'll see that milestone there, and we kind of keep track of when things are happening. Yeah, but I'd say that's a good estimate of when we close that round. Okay. We can say that maybe the 3 of us, we know that we're gonna have to spend a little bit of money between here and then, right? Maybe a little bit of travel, maybe a couple of dinners, maybe an office. I don't think that we would get an office, but I'd say, yeah, some subscriptions, right? We probably want a domain and an email. So maybe between the 3 of us, we're gonna kind of make this like $3,000 capital injection. We can put capital injections here, equity funding. That's us founders putting in some equity, but it's obviously not enough to pay ourselves, right? So if we go back to assumptions, we can change our start dates. And one neat little feature that we added recently is that you can choose that pre-seed close that we just added. We can set our start dates to the pre-seed close, that little milestone that we put in this monthly sheet. So notice that the model just keeps our $3,000 safe in the bank all through this year. And then after we close the pre-seed, we're going to raise, we start making all these bigger expenses. Now, the standard pre-seed in 2025 was $900,000. So we'll start there. We'll start with a base standard. This is not the exact amount of money that we're going to need, and not because that was the average, that's what you should put in there. We're just doing this as a placeholder. I hate seeing red numbers. Red numbers means that you run out of money. And actually, you should never have red numbers in your spreadsheet, right? So let's put the 900,000, and then we'll figure out if it's enough. Obviously, we're kind of taking away from that account, and if it's just the three of us, that money could last for all the way up to 2030, as you can see. But that's not all that we're spending. Okay, so we've added ourselves here. We've added our salaries. We can add more staff here so we can see. So notice that we have, we have some placeholders for the operations, product team, and so on. I want to say that, assuming that this is money closed in, the check comes in October, we start working on this. We'll probably end up doing the first hires by, say, December. It's not a great month to hire, but let's assume that we can. To the question of the recording, yes, it's live on our YouTube channel. It's called the Startup Club. My team might have pasted the link already to our Startup Club channel, where this is going to be recorded. Sorry if I'm going too fast, by the way. If I am, let me know in the chat. But okay. So let's say that, let's call it main hires, right? So main hires are going to start in December. So let's go back to the staff sheet. And maybe we have Stefan, who's going to be our CTO, but if it's just Stefan, it's going to take us too long to build this. So we're going to add some people, right? Maybe we're going to add some senior developers here. So let's enable this role, and we're going to enable this as a scaling team. And when we do that, we can set again the start date. In this case, it's going to be our main hires date that we just created. There's a good chance these developers are going to make more money than we are. So let's just get ready for that. That's perfectly normal because we are the founders and we have equity. Our employees might have a little bit of equity from the stock option pool, and you have a cap table here that you can use as well. But that's not the topic of today. By the way, we're doing a webinar next week, also on Thursday, that will touch a little bit on equity and the cap table and start evaluations. If you want to sign up, either subscribe to the channel or just wherever you found the Zoom link, you'll find the new link. Here's the link to the Start Club channel where you can get the recording. Okay, so we have main hires. We have a start date for them. We can notice that we have some extra functionality here, payroll taxes and benefits. So if we're putting them on payroll, normally payroll taxes in the US are going to run you like 20%. We have annual salary adjustments, which we might leave at 10. That's big adjustment, 10. But yeah, let's just leave that there for now. And the scaling, right? This is a neat little function that lets you say how many people you're going to add. So maybe we're just going to add 2 developers, and then every quarter we're going to add 2 more developers until we get to a team of 20. So with this, we're kind of basically assuming that over time, we're going to be scaling our engineering team. And we can go, notice that this is a staff sheet, but this is part of SG&A. Jeffrey's asking for the main hires, is a stock option pool conditional or adamant? In the US, for a company this early, right, 3 founders and you're the 4th person in the company, I'd say it's adamant. Like I would not go work for this company if I'm not being offered stock options, because it's very risky, man. It's just a company of 4 people, and you're going to be a core team member just by being one of the first hires. So I'd say it's pretty required for that early team. It's important, and it benefits both people. I think it keeps the team extra motivated. Yeah. Okay, so we have 2 every quarter. So if we go to the SG&A sheet, notice that we have this little staff section here. We can expand it and see hires and expenses per person. But if you look at the summary, we have the founders, and then notice that at the main hire state that we added, we have 2 more people. Those are the 2 engineers that we hired, and then 3 months later, 2 more, and then 3 months later, 2 more, and then 2 more. I've seen founders kind of have to go and do this like manually and just put one number and kind of, let me extend this. Yeah, and just add, okay, 1 here, and then another 1 here, and then we go from 8 to 10 here. Like that's just very tedious. So this staff sheet is a little bit of a dashboard that simplifies it for you. Now, obviously, it doesn't cover like it's not super detailed, but at the same time, it's like a quick rough way to estimate what the team's going to cost. Just by doing this, senior developers, maybe let's add some marketing people too. But for that, we kind of need to define a launch date. So, right. So if we assume that we started a pre-seed here and that we hired a team here, we can say that 6 months later, 6 months after we quit our jobs, we're going to launch, right? So this is our launch date. And yeah, so we're basically launching and still have around $700,000 in the bank, which is not too bad. At this point, by launch, our company is burning $57,000 a month, which we'll figure out if that's too much or not. We'll figure it out. But we'll get there. Denise, the recording did not stop. It's just that it's live on the YouTube channel. No worries. Okay. Okay. We have the senior developers. Yeah, we probably need to add a little bit more people at launch. That's what we're doing. So maybe some senior marketing people. We're going to scale that team. It's going to start when we launch, right? Maybe a month earlier, but yeah, let's have that be something like 80. We're going to add a person every quarter until we get to 10, right? So another team that scales along with us. And then we can just go to the SG&A sheet and add other expenses, right? So we're probably going to need an accounting team as soon as we close our pre-seed. We need to be compliant with things. That's probably going to cost us like $500. Man, I'm a bit old school. I think that offices are important, so maybe have a place where we can hang out or work a few times a day. Maybe you subscribe to Slidebean and you have that subscription. Google Workspace. This is a neat little cheat sheet that you could use, which is you can Google. I think it's what, $8 now per seat. You can just take the head count, right, which we know is accurate to our adjustments, and multiply it by 8. Right. And if we drag that formula along with on the Google Workspace line, notice that it scales the number, what we're paying here scales along with the team size. Right. So we can actually turn this line black because now it's kind of like being formula driven rather than a blue input, but it automatically scales that. So if you need other more expensive services, I don't know, Adobe or like more expensive services, you can also do that, multiply it by 49. And yeah. It's great. Jeffrey, how considerable is to reduce headcount higher by automations? Yeah, I mean, obviously, we're not ignoring that AI exists. It's just that that varies business to business. I'm trying to do a general business now, and I don't think that you can just replace the entire team with AI, at least not yet. Luckily for all of us. Okay. So we have a team, right? We've established kind of a little bit of a team situation. We know that we start in October. We know that we launch here. Again, an important thing is we might need to pay for some of this stuff earlier, right? So if you want to use Slidebean Pitch, maybe you start paying for that in March, or you want to have some like a landing page hosting, maybe Webflow. I think that's what, like 49. And you want to have like this landing page about your company that exists already. And maybe you need to buy a laptop, but I'll show you how to do that in a sec. But yeah, like these expenses that we add early, notice that we're taking away from our $3,000, and we know that we still have enough, right? If we start the company with zero, we know that we needed $500, and where they come from, it's good that the founders sit down and agree, like those little expenses that we have to make before money comes in, we have to deal with ourselves. Okay, let's jump into revenue now. It's about time. So we have this little chart here too. Notice how it scales down as our expenses get bigger. But let's just forecast for a little bit of revenue. So let's use the SaaS model to estimate. We established that the launch date was going to be in March 27. So let's choose that, March 27. And then, how is that launch going to go? Right. Let's say that at launch, because we have this marketing team that's been working on it, we have that landing page that we launched early. Maybe that's going to cost us, we're going to launch with, say, 5,000 visits, right? By the time we launch, at the moment we launch, we already have something like 5,000 visits. That's a year and a month from today, right? March. So the work that we're going to be doing in the meantime hopefully builds up to that, right? And we've assumed there's this marketing team that starts at launch, but if you want that traffic to be 5,000, maybe we should start that team along with the rest of the main hires, just so that it's realistic, right? And how much does that traffic grow every month? Again, we don't want to assume that it just grows magically. Here we have this team that's scaling, right? Every quarter we're adding one new person. So maybe I think this makes sense, 10%. And then we have conversion rate from traffic to sign up, which I think 15% is actually a pretty acceptable standard. Let's go with paid marketing, right? So paid acquisition. So paid acquisition, we're venture backed, right? We might raise a few $100,000. We want to start strong. We maybe want to start with, say, 20K a month in marketing budget. And then we're going to scale that marketing expense, 10% every month, right? So 20 to 22 to 24. I'll buy that. Again, we're venture backed, right? So we raised that money so that we could be aggressive about this. Good. So then we'll move into cost of acquisition, right? How much is a sign up going to cost us? $5, I think, is a bit optimistic for a sign up. I think that in reality, that might be something like 15 in this day and age. Yeah. And also, we're starting from scratch, right? We don't know anything. We might be able to optimize that number later, but we don't want to start with the optimized number for the forecasts. And then conversion rate, right? We said that our sign up conversion from sign up free to paid is about 3%. 5% is the higher end of this benchmark. I'd say that we probably want to stick to something more conservative, maybe 3%. And then let's assume that this is a $99 a month product. And with some monthly churn, 5 is good. 5 is good. And then finally, the costs, right? This also scales along with our revenue. How much do we have to pay per active user? This is per paying user, not per free trial. And let's assume that there some AI infrastructure cost, but nothing too major. So $3 per user. Now, by doing this, notice that in revenue, the model is doing everything for us. It's taking the organic traffic and the paid marketing budget. It's converting it and giving us the number of signups that we expect to get from one and the other, right? So 2,000 signups at launch, and then 2,200, and so on, scaling. And then customers, right? Because we have that conversion rate from sign up to paid, 62 customers the first month, and then 68, and so on. That's the total, and then the total customers, right? Because these are cumulative, they're on a subscription. And then revenue, right? MRR, monthly recurring revenue. And then we can go to the monthly sheet and see what that's doing for the company, right? And we see that number scaling as we move on. Now, notice that our cash balance at the end of the month is turning red in October. So in October 27, we are running out of money again. We're running out of money. Now, that's normal. Don't be scared. That's the way startups go, right? So if we look at the zoomed out version of this, this company, the way we're forecasting it now, starts with 400,000 revenue in 2027, then jumps to 2.2 million, 7 million, and so on. Notice that the costs are scaling proportionally, so we always have this 94% gross profit margin, and we have the staff that's also scaling. We're missing a few staff members, of course. We haven't thought about a support team, and we haven't thought about other things, but overall, we're seeing some scale here. And more importantly, like, this is turning profitable eventually, right? Very profitable, $100 million in profit. So I think we're on the right track. It's not that our business is flawed. What happens is that we just run out of money because we need, like all startups do, we need a few rounds of funding before we can get to profit. That's normal. That's why companies raise money. That's why we are in business, right? It's perfectly normal. So how do we deal with this? Well, we need to raise money again here in October. Here we would need to raise a seed round. Now, seed rounds in this day and age, in 2025 at least, were on average of $3.5 million. So you can do that as a benchmark. Now the problem, not 35, 3.5. Now the problem with 3.5, or with this seed round, is that in this day and age, in order for us to raise a seed round, we need for investors to start kind of taking our calls with seed rounds. We need somewhere like 30K in monthly revenue. I want to say 30 to 40K. So here, right? So based on our forecasts, it's kind of like here when we can start pitching seed round. And, well, can we raise a seed round in 2 months? I don't think so, right? We said earlier, a round of funding takes about 6 months to close. So what's happening here is that I got lucky that the numbers added up to the point I was trying to make. So if we start pitching in August, December is kind of like a dead month. So chances are we're probably going to be able to close this round somewhere like here, And we can add that budget here for the seed round, but we have run out of money. We've run out of money before our next round. And that's where I always say it's not about getting to 18 months of runway or 24 months of runway. It's about making sure that you have enough for the next milestone. We have enough for the next milestone, but we don't have a cushion in order to raise money. So what do? Right? The easier answer is, oh, we're short 400,000. Okay, let's bump up our pre-seed, raise 1.5 million, and we're good, right? We're done. No more red numbers. But this is, I mean, $1.5 million pre-seed round. It'd be a freaking huge pre-seed round. So I'm not sure if that's gonna cut it. If we stick with the standard, we're $400,000 over. We have to do something about it. Okay. And that's where the game begins in the model. We've set up the basics, we've established our first plan, but now we have to play this game of money, right? Maybe we can't afford to pay ourselves 60. We need to pay ourselves 45 and save a little bit of money there. Maybe we can't afford $100,000 senior developers. Maybe we need to cut that down to $85,000 per developer. And that means that we're probably going to have to give them more equity or compensate. Same with the marketing team, right? Let's cut that a little bit. Not 600, 660. Okay, getting there. We're 163,000. What if we cut people, right? And this is where this can get very sensitive, right? And say, well, we're not going to hire 2 engineers every quarter. We're only going to hire 1. It's going to be a slower ramp up of team. Good, okay, but what does that do to our launch, right? If we're going to go from here to here in 6 months with hires for 4 months, now our launch got delayed because we have a smaller team, right? So we have to push the launch a little bit further to May, and we have to push this launch date to May as well. So what does that do to our, is it May 27? Yeah. So what does that do to our runway? We delayed the launch because we have a smaller team, but we made it. We made it. That was quick. Sometimes it takes a little bit more tweaking to get to the right number. We made it. We made it with $100,000 in cushion. We can even raise less money now. We can even cut that down to 850. Save a little bit of money, save a little bit of equity. We still have a $68,000 cushion, and we have enough for the seed round. This what I've just done here. Hopefully, not too fast. Hopefully, at a good pace. What I've done here is that's literally the job of you as a founder to to make sure that you don't run out of money and to estimate a round of funding correctly. So I'm going to go back to the slide. We're almost going to jump into questions. Go back to the slide I showed you earlier. So now, after doing this, now our round size is no longer an arbitrary number. Now we know that we can raise 850 and it would be enough, right? Assuming that our assumptions are correct. We're no longer doing 10% scaling, right? We're understanding the marketing cost, and we're understanding the cost of acquisition and the conversion rates, and we're using those real world variables to see how that feeds into our company. And of course, we're not thinking of months of runway. We don't even care months of runway. What we needed to do is to get to the next milestone, so we have enough money to get to seed. That's the idea. We've fixed it. We've learned how to forecast for growth. So 2 quick commercials on how else we can help. My team and I can help with this. So we have a financial modeling bootcamp. It's honestly like a 3-4 hour version of this with a more eloquent version of me. It's pre-recorded, but so that's available on our website. My team's going to paste the links to that. Honestly, a really good bootcamp. I think it's almost 1,000 people that have taken the bootcamp now, and overall they've been pretty happy. The idea is that you don't need our spreadsheet or any spreadsheet in particular. It's like the bootcamp goes over everything, like how to build one of these models, either using our own template or using your own spreadsheet if you don't want to use our own, if you don't like our color coding. But yeah, and obviously we've been working on a SaaS company, but the bootcamp goes into building a model for a marketplace business or for a mobile app or for a media company, right? So how do we understand the variables and how they connect to one another? So that's there. Check it out. The other way we can help is our team. We have a couple of subscriptions where our team kind of gets involved in this. Our fractional CFO subscription, you get assigned a team member and you sync with them once a month. That team member builds the model for you. So basically, we take one of our spreadsheets, we customize it to your own company, and then we teach you, of course, how to use it, because the inputs of who are you going to hire? Are you going to hire a person this month or next month? Or is the product, the first version to launch, is it going to take 5 months or 6 months? We can't answer that question. That's obviously very different from business to business, but knowing where to put those values, knowing how to adjust these values in the spreadsheet, and also helping you track historicals once you launch and helping you track the actual KPIs and using the historical numbers to forecast for the future, like that's what our team gets involved in. So that's kind of like very much a fractional CFO point of contact that you can connect with every month. And that starts at just $199 a month if we can be useful. That's all I have. Now we can just do questions. I have like 10 minutes left, so let's do it. Oh, sorry. Man, I can't believe this. I had enough time for this. Normally I run over a little bit, but we had enough time. We forecasted the business. We fixed it. We got to the next seed round. That's good. Okay, I see questions. Da, 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 yeah. So the Shanti, I think hopefully you were able to find the template in the platform. Hopefully it's not that hard to navigate. But yeah, you need to sign up for Slidebean. Again, it's free and you'll be able to access it. Jennifer, we have a B2B app in a wellness space on a subscription basis, yearly or monthly freemium model. We're planning on early users enrolling the first 2,500 by activating in specific communities and networks, partnerships, affiliates, which has a low CAC, cost of acquisition, of $5. Two questions. Is it a fair assumption for a cost of acquisition with that method? After those early customers, how would you calculate that cost of acquisition? Yeah, so two notes on cost of acquisition. There are two cost of acquisitions that we dealt with in the spreadsheet that we worked on. I'm going to share the screen again so I can show you. And it's important. Sometimes people get confused about cost of acquisition. One cost of acquisition is this, right? What we had here, where we had a marketing budget and how many of those signups we convert into, I'm sorry, how many of those dollars we convert into signups, right? This is a cost of acquisition for a signup. Really, if we wanted to be really strict about it, we would call this a cost per signup. And that's different. That's different from your general cost of acquisition, because your general cost of acquisition of a customer would be a mix of both of these, right? So actual CAC would be, oh, sorry, not there. Actual CAC. Yeah, so the actual CAC would be all the dollars that we spent divided by the amount of customers that we got. I'm going to do this in revenue. So here in revenue, we said that we have 62 new customers, right? So our actual CAC would be the number of customers divided by what we spent in marketing. Is that right? Sorry, the other way around. My bad. The total spent in marketing divided by the total customers that we got, right? So that means that our cost of acquisition here was $322 based on these assumptions, right? Because what we were seeing here first, sorry, this is just the cost per sign up, and this is the cost of acquisition. So cost of acquisition for a general cost of acquisition for a product is rarely, or for a paid customer, right, is rarely $5. It's usually tens, if not hundreds of dollars. It of course varies per product, varies per industry. I think that $5 for a sign up is even very, very optimistic. Because in this day and age, if you do ads on TikTok or wherever, how much does a click cost? $3, $4 for a click. I think that's pretty standard. So you're basically saying that everybody that clicks your ad signs up, which is that's unlikely, right? So that's where that $5 seems a little bit too optimistic. Yeah. Do you guys have a list or team of coaches that we could hire to consult one-on-one to help us raise and build out the models? Yes, our own team. Cool. Yeah, we need one or more entry points into the Slidebean startup universe. I know we're supposed to do everything at once, but a path or routes to knowledge acquisition would be great, useful. This would be a start here, then next. Oh, that's a good question, Jim. I haven't been asked that before. Most of the time, I think people run into the financial model problem, into the budgeting problem when they're doing their pitch decks. I think a pitch deck is, I've been to pitch decks for too many years. I think it's 12, 13 years since we started the pitch deck side of the business. The pitch deck is great because it starts very easy, right? It starts with, oh, um, what are we building? What problem are we solving? It kind of forces you to answer those questions. But then as you get to the second half of the pitch deck, you have to answer some more financial questions, right? In a pitch deck, right? A pitch deck is like a tiny business plan that you present to an investor, but you have to talk about how much money you need, and you have to talk about how much revenue you're getting, and when and who you're going to hire and how much that's going to cost. So I think founders a lot of the time they start with a pitch deck, and when they run into this wall of whoa, hold on, how much money do I need to raise? And how much equity do I need? Like that's when they start, like when they have to unlock like this Pandora box of all these other questions that they maybe hadn't asked themselves. So a pitch deck is a great start, by all means. If you're looking for like where to start these questions, like I don't think that and I don't think that honestly anybody should make a course of how to start a company from 0 to 100, right? Because I think companies start in very different circumstances, and I don't think that there's a good cookie cutter answer to it. I think that all companies, wherever they start running into the same questions, right? They start running into the pitch deck question, or the forecasting question, or the budgeting question. And I mean, blatant plug, but I think our YouTube channel covers most of those questions, and that's the way most people run into us, because we've made a video about most of those questions. And then, most people will, watch one and figure out that they understand it. And then most of our traffic on our Startup Club YouTube channel comes from search, just people finding the answer to these questions. So that happens very organically, I think. But good question, Jim. Ryan, so the FCFO offer sounds great. Fractional CFO. Do you get access to Slidebean software with that? Yes, you get access to all of our software. You even get a kickoff call with me, which I run once a week in like small groups, and I jump into the models once they're built. So you normally 3 months in, after you guys have run some forecasts, I like to jump in myself with your financial analyst, and we do work a little bit, figure out what assumptions are maybe too optimistic. Obviously, every business is different, but yeah. Oh, Jim is asking, your YouTube channel provides great stuff. Which video to watch first? I'd say watch our most popular video is Funding Rounds Explained on the Startup Club channel. You'll see it. It's like clearly the most watched video, maybe 300,000 views at this point. That's where I would start. It's like the very, very general. And that video kind of opens a bunch of questions that maybe you have the answer to or you don't. But I think that that's like the one that'll route you to everything. We should probably put it more prominently now that I think about it. Okay, I have another call. Actually, one of our financial model customers. In 2 minutes, I'll do the last question from the YouTube. Oh, two questions from YouTube. Would you recommend that there be a free package or only paid packages and hard paying wall for SaaS? In my experience and traumas, the problem, I mean, I don't think there's anything wrong with freemium, right? People need to try software. The problem with freemium, or the danger with freemium, is if it's paying too much attention to the free people. Free people are, for the most part, bad feedback, because they're not the ones that will retain or pay for your software. So yeah, like if you're, I mean, our product, I don't think we could have a paywall on it. Like I think people need to be able to use some stuff for free. That stuff is available elsewhere, right? You can find other financial model templates, right? So why would we charge for ours? We sort of have to accept the reality of the space. We just think that ours is better, so we give it to you, and we know that that sometimes leads to conversions for our product. So I mean that varies. And then the last one, I have been working on my starter pitch deck. Oh no, it wasn't a question. Oh yeah, how much or how less detailed should it be? That's a question. I would say someone needs to be able to read your pitch deck in 4 minutes. That's the time that an investor usually spends. We track it. We've seen it. How much time an investor spends reading a pitch deck, and it's about 4 minutes. So if you have more than 4 minutes worth of content, then they're probably not going to read it. So that's a good benchmark that you want to use. Freemium subscribers don't even fit the 80-20 rule. They're 90-10 at best. Less than 10% convert to paid. Yeah, like I said, it's, in my experience, I mean, for our app, it's like 96-4, right? So most of them don't pay. And I mean, honestly, from a metrics, conversion rate, feedback, product feedback standpoint, we pay less attention to the free people, even though they're more. Okay, guys, I do have to run now. I don't want to be late. So hope this was all useful. Sign up for Slidebean. Grab the template. It's free. Start using it. And please don't make the same mistakes that we did when we were pitching investors and budgeting our rounds. Don't run out of money. Bye, guys.